Let's just kick off with the economic update. The economy is growing at a reasonable pace, following a soft patch at the end of 2016, early 2017. The main drivers of economic growth remain similar to the budget update, although revisions to GDP by Statistics New Zealand mean growth is coming from a lower base, and the level of real GDP is lower than the budget update throughout the forecast. Growth is forecast to pick up to 3.7% in 2018-19, before easing to 2.3% in 2020-21. The outlook is underpinned by migration-led population growth, the continued cyclical upturn in the international economy, the stimulus provided by Budget 2017, and supportive monetary policy. Beyond 2018-19, slower population growth and reduced monetary policy stimulus leads to slower economic growth. The level of residential investment is expected to remain high over the year ahead, but further growth is constrained, reflecting the impacts of higher mortgage rates, tighter bank lending standards, and higher construction costs. And looking further ahead, strong population growth and still low interest rates suggest that residential investment will pick up, although growth may be slower than previously forecast. And reflecting these developments, the outlook for economic growth is a little lower than in the budget update. The pickup in economic growth over the next 2 years or so is expected to lead to a gradual decline in the unemployment rate towards our estimate of the long-run rate of 4.25%. As the labour market tightens, nominal wage growth picks up to over 2.5%. Headline consumer price inflation is expected to be variable over the year ahead and to increase gradually thereafter, rising to 2.1% in 2019-20. Forecasts of real wage growth have been revised a little higher compared to the budget update. In aggregate, New Zealand's main trading partners, economies that grew much as expected in early 2017, although there were some offsetting variances from the budget update forecasts, with Australia, for example, experiencing weak growth. The cyclical upturn in the international economy is expected to continue, with little change in the outlook from the budget update, although a range of risks remain, and key risks to the international economy are familiar. They include high levels of debt in China, uncertainty around the fiscal stimulus in the United States and the normalization of monetary policy, the ability to achieve sustainable higher growth rates in Europe and Japan remain uncertain, and high household debt and housing market risks in Australia. And of course, other risks include the impact of the United Kingdom's exit from the European Union and the ongoing political debate in some countries about the merits of trade liberalisation. New Zealand's goods terms of trade remain high. They're estimated to have increased further in the June quarter, but are expected to decline later this year, partly reflecting recent falls in dairy auction prices. However, the terms of trade are assumed to remain a little higher than previously forecast, largely reflecting improved prospects across a number of export commodities and a weaker outlook for oil prices. Dairy, meat and forestry prices are all benefiting from stronger demand in China and from regulatory restrictions on alternative sources of supply. Oil prices have been weaker than anticipated in the budget update, reflecting falling production costs, particularly of US shale oil, which is expected to persist. So looking over the forecast period, real production GDP is forecast to grow by 3% on average over the 4 years to June 2021, marginally lower than the outlook budget of 3.1%. Recent gains in the terms of trade lead to a modest upward revision to estimates of nominal GDP growth in the 2017-2018 fiscal year. Thereafter, nominal GDP growth is forecast to be a bit lower than in the budget update. Cumulatively, Over the 4 years to 2021, nominal GDP is 0.2%, or $2.6 billion lower than in the budget update. The starting point for core Crown tax revenue is up $1 billion on the budget update, but is not expected to persist into the out years. And combined with a lower outlook for nominal GDP growth, total tax revenue forecast is similar to the budget update by 2021. Now, as you know, when economists publish forecasts for growth, the forecast represents a midpoint or the Treasury's assessment of the most probable outcome based on information currently at hand and key judgments made. And in the real world, of course, there are always risks and uncertainties around any set of forecasts. And one way of communicating these uncertainties is through fan charts, which use past forecast errors to illustrate the likely range of future outcomes. Another way is through alternative scenarios, which illustrate how the economy and fiscal position may deviate from the main forecast when key assumptions are altered. And the Treasury outlines the primary economic risks and uncertainties in the Risk and Scenarios chapter in the document, which I do recommend you read, along with the specific fiscal risks chapter, which disclose policies, including those under active consideration, which aren't certain enough in terms of their likely timing or measurement to incorporate into the fiscal forecasts. There are always risks. I mentioned some of them, some of the key international ones earlier: Chinese debt, US fiscal stimulus, US fiscal monetary policy normalization, risk in Australia. Some of the key domestic risks include how households might respond to high household debt levels, changes in asset prices, or to future interest rate increases, the future magnitude, persistence, and impact of the migration cycle, and uncertainty over the degree of spare capacity in the economy. And because there are always degrees of uncertainty around forecasts, the chapter includes, as usual, a couple of alternative scenarios to illustrate potential alternative ways that the economy could pan out and why. Scenario 1 shows the impact of a higher terms of trade and stronger inflation outlook, whereas Scenario 2 examines the implications of weaker than expected momentum in the domestic economy. And the chapter also includes fan charts for nominal GDP and tax revenue, as well as fiscal sensitivity estimates. We'll just move on to the fiscal update now. We won't know the final results for the 2016-17 fiscal year until early October. However, we expect the results will be stronger than last year and what was forecast in the 2017 budget update. So based on existing spending and revenue settings, we forecast the government to run operating surpluses over the forecast period. The forecasts assume operating allowances of $1.7 billion for budget 2018, growing at 2% each budget until budget 2020, and they also assume capital allowances of $2 billion in budget 18, and then $2.5 billion for subsequent budgets in the forecast period. An operating surplus of $3.7 billion is expected in the 2016-17 fiscal year. The operating surplus is expected to grow steadily in the remaining years of the forecasts, rising to $6.4 billion in 2020-21. This improvement in key fiscal indicators is largely on the back of strong growth in tax revenue, which has grown by 7.4% since last year. 2016-17 core Crown tax revenue is up $1 billion on the budget update. The strong tax result in 16-17 is particularly apparent in this graph, with the Obergall surplus expected to be around $3.7 billion, as I said. However, we're not expecting all of that strength in tax revenue to continue throughout the forecast period. There are two broad reasons for this. One is that the macroeconomic outlook has been slightly downgraded since the budget update. And in addition, we believe that some of the strength in the 16-17 tax revenue came from particularly high investment returns that we don't forecast will endure. We're also expecting some rephasing of expenditure in the 2016-17 year into future years, while ACC costs are expected to be higher off the back of the latest claims liability valuation. The risks and scenarios chapter includes discussion about the range of potential tax revenue outturns over the next 4 years. Now moving on to net core Crown debt. The expected improvement in the 16-17 results previously mentioned mean the starting point of net core Crown debt in 17-18 is better by nearly $2 billion compared to the budget update. As a result, net debt is expected to lower in nominal terms in 2016-17 than it was in 2015-16, before increasing in the next 2 years, primarily due to the residual cash deficits in these years. And I'll show those in a minute. Overall, core Crown capital spending is expected to be $30.5 billion between 2017 and 2021. The forecasts assume capital allowances, as I told you, of $2 billion and then $2.5 billion. Net core Crown debt is expected to decline as a percentage of GDP, and by 2020-21, it's expected to drop below 20% of GDP. Beyond the forecast period, net core Crown debt is projected to continue to fall and to be within the range of 10 to 15% by 2020-25. The projections included in the preview assume allowances remain unchanged from those used in the government's 2017 fiscal strategy report. So the ones I read out are exactly what the government set out in its FSR at budget time. So looking at the fiscal outlook beyond 16-17, I'm sorry this is probably challenging those of you with sight issues, and I'm one of those, by the way. But basically, the picture you've got up there shows revenue continue to grow at a faster pace than expenditure, leading to growing OBGAL surpluses over the last 4 years of the forecast. Residual cash is largely neutral across the forecast period. In nominal terms, net core Crown debt is expected to stay relatively flat over the next 5 years and continue to decline as a percentage of GDP to reach 18.8% by 2021. Net worth attributable to the Crown continues to grow over the forecast period. So overall, we're expecting OBGAL to be fairly close to the budget update over the next 4 years. And that concludes my presentation. The Treasury's next set of economic and fiscal updates will be sometime in November. Thank you very much.